Hello and welcome to the part 2 of individual retirement accounts. I'd like to start with section 4-6B, Roth IRA conversions on page 421. A Roth IRA contribution, or I should say a conversion, is when you take a traditional IRA and you convert it to a Roth IRA. And you would do this wherever you keep your traditional IRA. Somebody can help you with that there. The reason for this is when you are in a tax situation when you can afford to absorb the amount of the conversion from a traditional to a Roth. Now, an example of this would be that you're running a sole proprietorship, you have a Schedule C, and you have a loss that year on your Schedule C, and you're going to claim, standard or itemized deductions, and you're also going to claim your exemption. By the way, remember that the exemptions are phased out at the end of, or they sunset at the end of 2017. All right, the exemptions will no longer be available in 2018 and afterwards. That was part of the new tax reform bill that was signed in December. So this is what the paragraph on page 421 is talking about. So, if you're working with a return that has a zero taxable income, all right, ask the person, do you have a traditional IRA? And if they say, well, yes, I do, even though they may not have taken a deduction for it that year, you could say, hey, you have until April 17th of 2018 to make a conversion from a Roth or from a traditional IRA to a Roth IRA. All right, and normally you would be taxed on that, but because you're in a negative taxable income situation, you can convert exactly the amount that would take to make your taxable income zero, and then you would not be taxed on any of the conversion amount. And of course, once it becomes a Roth IRA, it's never taxed again, okay, as long as you abide by the rules of Roth IRAs. Let's take a look at those at the top of page 4-22. All right, what I would like you to do is to go to page 449 in your book. Okay, let's do that. All right, page 449 is an example of a 1099-R for Allison Gator. All right, she is the spouse of the taxpayer in your cumulative problem that is due at the end of the semester. Okay, a 1099-R is the form that is used when anybody gets a distribution from any kind of a retirement plan, whether it's a pension plan at work or whether it is an IRA. If it is an IRA or some plan like that, all right, then the little box between boxes 7 and 8 will be checked. Okay, what is very important is that you check whatever code is in box 7 of form 1099-R. Okay, if that code says 1 or L1, meaning alone, then that person is going to be subject to a 10% early withdrawal penalty, okay, unless they can meet one of the 9 exceptions at the top of page 422. Okay, this is of course assuming that they took an early withdrawal before the age of 59 and a half years old. All right, and there's a lot of taxpayers that do take these distributions. So whenever you're presented with one of these 1099-Rs and there's a code 1 in that box, ask them, what did you do with the money? All right, and if they say, well, we just needed it for regular household bills, then you leave it. You go to the software, you code it as a 1, and then whatever the amount is in box 1 of the 1099, 10% of that will automatically be taxed And if you go to the page 2 of the 1040, okay, you'll see on line 59, it is called the additional tax on IRAs. Okay, and that's where that tax will automatically be inserted. Now, you will probably also notice that on box 4 of the 1099, the payer would automatically have withheld 20% of the amount on line 1. So the gross distribution will be X number of dollars, and 20% of that amount will be in box 4. All right, that's what normally happens with a distribution from a pension plan or an IRA. Okay, so again, it's really critical that you look at box 7 on this form. Now, as far as the Gators go, as far as Allison Gator goes, her code is G. All right, that means she had a rollover. All right, that means whatever this plan was, she rolled the money over into an IRA, and this is what usually happens. All right, okay. A lot of times people will leave their employer, and they will have had a 401k, and the employer's is not going to keep tracking this pension plan anymore for the taxpayer, and that's what happened to Allison Gator. Okay, so what it is she opened up an IRA, okay, and then she had her 401k directly transferred into that IRA, and that's why you see code G in box 7 of Form 1099R. Okay, so back to page 422. All right, unless your client, okay, can qualify for one of the 9 exceptions at the top of page 422, okay, they're going to be subject to that 10% additional tax, assuming that they took the distribution before the age of 59 and a half. Once you turn 59 and a half, you're fine. Okay, on a Roth IRA distribution, okay, you can make tax-free withdrawals as long as you have waited 5 years. Okay, 5 years. All right, once you also turn the age of 59 and a half, all right, all these rules go by the wayside. All right, if you do take a Roth IRA distribution prematurely, in other words, before you turn 59 and a half, or the 5-year holding period has not been fulfilled, okay, then you have to know how much they originally put into their Roth IRA, or how much they put into it total. All right, the distribution up to the amount of the contribution is tax-free because that money's already been taxed. So if they take an early distribution on a Roth, and that distribution exceeds the amount of their contributions, then that amount will be taxed as as income on the return. Okay, all right. So that covers a little bit about IRAs. All right, and we're going to come back to that a little bit later in the book. Okay, that's the end of this video recording.